This is Al Brooks. Thank you for watching the Brooks Trading course. This video is about pullbacks and bar counting. I'll begin by talking about what exactly a pullback is, and then next I'll talk about what bar counting is. In a bull trend, like we have over here, a pullback is when the low of a bar goes below the low of the prior bar. So there are no pullbacks here. This is the first pullback. In a bear trend, it's the opposite. The first pullback occurs when the high of a bar goes above the high of a prior bar. You can see we had a bull bar here, but it did not go above the high of the prior bar, and this bar did not go above the high of that bar. So this is the first pullback in the bear trend. Here we have a bull trend, but look at this. We have a tail on the top of the bar. So the market went up and it went down, but it did not go below the low of the prior bar. And here we have a bear bar. So the market opened here, traded down, and reversed up, but this bar did not go below the low of that bar. So it's not a pullback, at least not on this time frame. Let's say this is a 5-minute chart. This is an inferred or an implied pullback on a lower time frame chart, just as this is as well. So even though it did not trade below the low of any 5-minute bar on a smaller time frame chart, like a 1-minute, a 2-minute, or a 3-minute chart, it probably did trade below the low of the prior bar. So on the 5-minute chart, this is implying that there's a pullback on a smaller time frame, and the same is true with this. So for example, a 5-minute chart, no pullback, but we have a bear bar and we have a big tail. 1-minute chart, you can see this bar went below the low of that bar. So in fact, there was a pullback. So this bear bar on the 5-minute chart is an implied pullback. It implies that there is a pullback taking place, not on the 5-minute chart, but on a lower time frame chart. And likewise, this tail right here, where the market went up and down, here it is here, up and down. And in fact, this bar traded below the low of that bar on the 1-minute chart. So there was a pullback here. That's important because pullbacks tell you that the trend is probably going to resume soon, and it gives you an opportunity to enter. So traders look for pullbacks and they enter. If they see an implied pullback on the 5-minute chart, they may choose to buy at the close of that bear bar, betting that the trend will resume and that it's only a small pullback on the 1-minute chart. I'm always paying attention to pullbacks, even implied pullbacks. Here a bear bar, here a prominent tail. Here we have a bear trend, and any bar that has a big tail on the bottom is an implied pullback because on a smaller time frame chart, the market went up and it probably went above the high of a prior bar. So here's the 5-minute chart, and we have an implied pullback, and it's an actual pullback on the 1-minute chart. So this is this, and then the market went up, and here the market went up. This bar went above that bar. So that tail on the 5-minute chart implies that there probably is a pullback on the 1-minute chart. When you see a relatively strong trend and you see a tail like that, a lot of traders will sell that close, betting that the trend will soon resume. You know, you're looking for reasons to enter, and that is a reason to enter. The purpose of looking for pullbacks in trends is they give traders a high probability trade. So for example, here's a pullback after the market went up about 8 or 10 bars. Chances are the market's going higher. So traders can either buy with a stop 1 tick above that bar, or 1 pip above if it's a Forex market, or they can buy with a limit order either on the close of that bar or at the low of that bar. This little tail on the bottom of the bar is probably a small pullback on a smaller time frame. The market went up here and then down more, and then up. And this is a pullback on this time frame, the 5-minute chart, because the low is below the low of the prior bar. Likewise, this is a pullback. And then here's a second pullback within the same bull flag. So this entire 4 or 5 bar sequence is a pullback, and it pulled back twice. Once, tried to resume, twice. And this is a bigger pullback. Here it lasted about 20 bars or so. Traders are looking to buy when the trend resumes. So when they see a pullback, they place a buy stop order 1 tick above the high of the prior bar, so that when the market goes above that bar, they get long. Now, in a bull trend, if you buy 1 tick above this bar, you do not put your stop there. You have to put a stop way down here. In the video on stops, I will talk about the correct place for stops. In general, when you are buying in a trend, you're taking a high probability trade. When you're taking a high probability trade, you have to pay for it. There's somebody taking the opposite position, so you have to give that person something. Usually, you're giving that person a good risk-reward ratio. And in a bull trend, that usually means that your risk is big, his risk is small. When you get high probability buying pullbacks, the other side is getting good risk-reward. Your stop is down here. And this is what I was talking about, use the wide stop. Now, I said a pullback is a high probability bet that the trend would resume. However, at some point, the pullback can grow to so many bars that the probability of the trend resuming up is the same as the probability of the trend reversing down. In general, once a pullback grows to 20 or more bars, I start using the term trading range instead of a pullback. And when I say trading range, what I'm meaning is that the probability is about the same now for the bears as it is for the bulls. Early on in a pullback, the odds are it's going to resume, but the more bars that get added to the pullback, the lower the probability becomes for the bulls and the higher it becomes for the bears, and at some point it's equal. At some point in here, it's just as likely that we're going to go up as it is that we're going to go down. The bears see a double top bear flag or a lower high major trend reversal. The bulls see a high 2 buy or a double bottom bull flag, and they each have the same probability of success. Now, if you buy anywhere in here, your stop is over here. If you buy here, your stop is over here. And at some point, you raise your stop. Once you see enough of a trend resumption and it's strong, you raise your stop to the bottom of the most recent strong breakout. So if you're a bull and you bought anywhere, if you bought here, if you bought here, if you bought here, if you bought there, if you bought here, if you bought there, your stop is still here. It doesn't matter where you buy. Your stop is not dependent on where you buy. Your stop is simply dependent upon the price action. And if you're buying in a bull trend, your stop goes below the bottom of the most recent bull leg. Now think about that. So it doesn't matter where you bought, right? If you buy up here, this is your risk. At some point, the stop is so far below that your risk is great. And if you're an institutional trader, you have to reduce your risk. Every institution has a defined risk, a maximum risk that they will allow. And if a trend goes on too long, the stop is too far, the risk is too great. The easiest way to reduce risk is to reduce the position size. So they start to take partial profits. And when the bulls start to take profits, you get a pullback. When bulls take profits, the market goes down or sideways. And after a certain number of bars, the bulls conclude that the bears are unable to create a reversal, and the bulls buy again. And then once they have 3, 4, 5 good-looking bull bars, they now put their stop here instead of here. So they again reduce their risk. But when the risk gets too far again, they have to take some profits again to reduce their risk. Sometimes you get very deep pullbacks. For example, here, a very strong reversal, probably a bull trend. We have a bear trend, a bull breakout, a higher low major trend reversal, and a very good trend up here. However, your stop is down here. And this might be simply a trading range, and it is. It's a trading range and a bull trend. It's technically still a bear trend because we're still below this high, and we could be making a very broad bear channel. But in any case, at this point, it's very strong, and you're either in a bull trend or a trading range, and you need to stop down here because sometimes you get an extremely deep pullback, and you don't want to be stopped out. As long as your premise is still valid, the trend is still good, and it's okay to be in your position, but you have to rely on your stop. Many traders in a situation like this would get out early. Instead of relying on their stop here, they say, this is too much of a reversal. I'll just get out, and then I'll look to buy again if we get a higher low and we start to turn up again. We have a wedge bottom here, 1, 2, 3, and then we break out. So some traders would exit here and then buy back here. So we have a bear trend, and every lower high is resistance. Some lower highs are minor, and they're just part of a trading range, and it's common for the market to go above a minor lower high and then continue down to a new low. And the same is true when the market is starting to reverse up. You can still be in a bull trend, and the market might fall below a minor low. So a minor low is a pullback, does not fall very far. The rally is not all that clear, and a lot of times the market will dip below that, but still stay above the bottom of the bull trend. So we're still technically in a bull trend, even though we fell below this minor low and these minor lows. However, this low, this rally, is so strong that I think it's a major low, and the bulls do not want to see a pullback below this low. If it stays above that low, the bulls think this is still controlling the market, and they're happy to remain long. Look at this. We sold off and we pulled back. And we rallied and we sold off. 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 But there's something particular about each of those pullbacks. Something important about each of those pullbacks. So for example, we rally here and we sold off to about halfway down. At this point, the distance to here, where the bulls have their stop, is the same as the distance to here, where the bears who sold have their stop. So at this point, and the bulls assume it's going to go up here, the bears assume it's going to go down here. So for the bulls, this is their risk, that's their reward, equal. For the bears, they're risking to up here, and they're holding for a new low down here. So their risk and reward are equal. However, we're probably in a bull trend. Probably means 60% chance that the bulls will make money, 40% chance that the bears will make money. So a 50% pullback is a very important thing in a bull trend or in a bear trend as well. Because at 50%, risk and reward are the same for the bulls and the bears. The risk equals the reward, and it's the same for the bulls and the bears. But if it's a bull trend, the probability favors the bulls. If it's a bear trend, the probability favors the bears. So 50% pullbacks in a bear trend, the bears are looking to sell. So here's the top of the bear trend, the bottom of the bear trend, 50% pullback, we're stalling because the bears believe that they're still in control and they're going to be selling. They'll place limit orders, they'll sell below bars. Bulls see a pretty good bull trend at this point, and they're pretty confident, so they're looking to buy a 50% pullback. A lot of the math that traders use is based upon 50% pullbacks, not Fibonacci 62% pullbacks or 38% pullbacks, but 50% pullbacks have a rational basis. Fibonacci numbers have no rational basis, and most traders ignore them. I talk more about this math in the videos on measured moves and on the trader's equation and probability. Now, I said bears look to sell a 50% pullback. Some bears will place a limit order exactly at a 50% pullback, so when the rally gets there, they'll get short exactly there. That red box is where the bears would get filled. It has to go one tick above that red line for them to get filled on their short. If this was a Forex market, it would have to go one pip above. Likewise, bulls look to buy a 50% pullback from a rally. Now, this is a rally. At this point, the rally is right here, and it pulls back right here. As soon as this bar closes, the bulls will place a limit order to buy a 50% pullback. And look what happened on this bar. It went just below the 50% pullback, and then it raced back up again. That tells you that a lot of bulls liked this rally, this reversal, and they decided that if it falls 50%, it's probably going to go back up here. So a lot of bulls placed limit orders to buy there. Same thing here. The rally now extends up to here. It began down here. Here's a 50% pullback. So a lot of bulls will place a limit order to buy there or on the reversal up. A new leg up, this low, that high. Bulls place a limit order to buy a 50% pullback, and they might get filled on this bar. That bar clearly went, well, no, it's clear. It looks like it went below the line. And if it did, they would get filled there. Other bulls will simply say, hey, it didn't fill my order, but it's closing on its low. The bears are trying to reverse. I think the bulls are going to win. So as soon as they see that bear bar close, they'll hit buy the market. So they'll buy a strong bear bar, betting that the bear reversal attempt will fail and that the market will resume back up. Sometimes you'll have a very strong rally and a pullback that falls below the bottom of the rally. And it still can be a pullback from this rally. At least that's how I look at it. Sometimes you'll get a pullback that falls beyond the bottom of the bull trend, and a lot of traders will get stopped out or they'll get out on a big reversal down like this. But if they do, and they see this as a possible pullback from this rally, they'll look to buy a resumption up above this buy bar or above that bar. Here's the bar closing on its high. Maybe they'll buy above that bar. You can see a lot of traders did buy there. You can see we gapped down on the open here, and then we rallied strongly, and then again less strong, and then again less strong. 3 pushes up, 1, 2, 3. This is a parabolic wedge top, and it's a possible opening reversal and high of the day. So a lot of bears will sell below that bear bar. A lot of bulls who bought for any reason on the way up, like this close, that close, below that bar, that bear close, above this bear bar, they will get out below that bear bar just in case this parabolic wedge top becomes the high of the day and we have a bear trend down. This bar represents the bulls giving up. The bulls were hoping for a bull flag, maybe a resumption, and at some point they give up and they think, this is going to be an opening reversal down, and that's what took place right here. So at this point, the market's always in short, which means it's probably going lower. Not only do the bulls give up, the bears know what's going on as well, and they will sell as well. This still might be a pullback from this initial rally. It fell below the bottom of the rally today, and it also fell below the bottom of the entire bull trend, which took place at the end of yesterday. It still could be simply a big bull flag falling below the bottom of the bull trend. So traders will be ready to buy a reversal up. As I said, they might buy above that little doji bar. Traders who want higher probability wait for a strong breakout with good follow-through, and they buy here. So the traders buying here have a better chance of making money than the ones who bought here. However, their stop is down here. So they're risking more, but they're trading off risk-reward to get high probability. And traders do that all the time. Some traders like high probability trades, and they have to accept worse risk-reward. Other traders are mostly interested in reward, and they don't care if the probability is only 40%. They know that if the reward is 2, 3, 4, 5 times bigger than the risk, they will make money even if they win only 40% of the time. Now, about bar counting. Traders are always looking for reasons to trade, and there are reasons on every bar to enter. A lot of traders get anxious about entering. How do I buy? Why do I buy? What am I waiting for? Well, bar counting is one way to get a method to enter into a trend. For example, here, bulls can use bar counting to enter into pullback entries. The market sold off a pullback and it resumed up. So this is a pullback that resumed up. It sold off again and tried to get up a second time. So this is high 1. The first time the bar went above the high of the prior bar. The trend resumed down. This is a high 2. The trend resumed down again. This is a high 3. And bulls will buy, they'll buy all of these. They'll buy the high 1, they'll buy the high 2, not so good, bear bar. They'll buy the high 3, not so good, bear bar. They may wait for a micro double bottom here and buy. Rarely you'll get a high 4. Sometimes you'll get as much as a high 6. Sometimes you'll have a wedge, a bottom attempt. The market tries to resume up. It breaks to the downside again, and then you get another 2 or 3 legs down. So sometimes you'll get a pullback that actually has 6 legs. In general, if you start getting 5 or 6 legs down, you're in a bear trend and no longer in a pullback in a bull trend. If you look at a higher time frame chart, this is a very tight channel. It's probably just 1 leg down, and this is probably a high 1. So this is first leg down, pullback, second leg down. So if this is a 5-minute chart, and you looked at a 15-minute chart, this could simply be leg 1, pullback, leg 2, and a big high 2 buy. So they buy above this bar. Sometimes you hear the expression an ABC correction. Here's the A, first leg down is the A. The pullback from the first leg down is the B, and here's the C. And to me, that's a high 2 bull flag. So we have a high 1, bear trend resumed, and then the bull trend tried to resume again, a high 2. So it's a buy setup. A, B, C, buy above the high of the C bar, which is a high 2 bull flag, or an ABC bull flag. What you're going to soon discover is that most patterns are not perfect, and that is okay. That's just the nature of trading. Nothing is perfect. When traders start out, they always want a perfect trade. Hey Al, what's that perfect setup? I know you have it and you're not telling me. There is no perfect setup. If I had a perfect setup, institutions would quickly decide that, hey, we're giving Al money every time this pattern happens. Well, guess what? They would stop giving me money. So perfect trades can never exist. So if you're worried about perfect trades and perfect setups, you're never going to trade. The reality is nothing's perfect, but there's a reason to enter on every bar. But you just have to know what to look for, and that's what this entire course is about. I'm trying to show all the different kinds of entries that take place on every bar during the day, and then how to manage the trades. By the way, this is also a triangle. A triangle is a pullback that has 3 legs. So 1, pullback 2, pullback 3. So this is a triangle, 3 pushes down, horizontal pattern. If it was more angled down, I would call it a wedge. A wedge is just a triangle that's sloped down a little bit or sloped up a little bit. It can be sloped up a lot or sloped down a lot. But if it's 3 pushes and it's mostly horizontal, I call it a triangle. And you can see the 3 pushes down. And we have a bull buy signal bar above the 3rd push down. It reversed up. Traders will buy with a stop 1 tick or 1 pip above the high of that bar. So they get long there, stop here, and they would ride the trend up. Here we have a bull trend, and we have a pullback. This pullback ends when a bar goes above the high of that bar. So this is the end of that pullback. Sometimes you'll get more pullback, a second or a third leg down, but this pullback ends as soon as a bar goes above its high. And traders will buy that as a high 1 bull flag, especially given that this is a very tight bull trend. It's about a 9-bar bull microchannel. Every low is at or above the low of the prior bar. This is the first pullback in 9 bars. Very strong bull trend. So traders will either buy with limit orders at this low, or they'll buy with a stop just above that bar, get filled here, or they'll even buy closes, or they'll simply buy at the market. Every one of these bars, every instant that this is forming, there's a reason to enter. If you're nervous about entering at the market or on the close, well, then you take a pullback entry, a bar counting entry. We pull back, you buy above the high of the pullback bar. Stop down here. And I said a few minutes ago that sometimes you get a second or third leg down, but if you start to get 4 or 5 legs down, you're probably not in a pullback. You're probably in a bear trend. In a bear trend, a pullback ends when the trend resumes down. So here we have a pullback. This bar went above that bar. This pullback ends as soon as a bar goes below the low of that bar. The pullback can fail, and we can go up for a second or a third leg and maybe form a wedge, bear flag, and then resume down. But this is a reasonable short, especially with these 2 big bear bars, so a fairly strong bear trend. A lot of times, most of the time, the low one will be profitable. Now, if the pullback grows, if you start to get 3 or 4 consecutive bull bars, you're probably in a bull trend. If you get 2 or 3 or 4 legs up, you're probably in a bull trend. So sometimes a pullback can grow into a reversal and no longer be a pullback. Here we got a pullback above this bar, and then we got another pullback here. But once you start to get, here we have 5 bars with bull bodies all closing near their highs. This is probably a reversal, and the market's probably always in long. So this is no longer a pullback in a bear trend. It's now a bull swing, possibly a bull trend. I've already talked some about bar counting, and I'm going to talk more about it now. With bar counting, I count the number of attempts a trend tries to resume. So here we pull back, trend tried to resume. Here we pull back, trend tried to resume. Here we pull back, tried to resume. Pull back, tried to resume. Each attempt at resumption in a bear trend usually has a bear bar. So we got a pullback and then a bear bar. We have a pullback and then a bear bar. Bear trend trying to resume. Bear trend trying to resume, successfully resuming. So the bear bars are the attempts at trend resumption down. So we tried to resume here. We tried to resume here. We tried to resume here. We pulled back once, pulled back twice, pulled back 3 times. So this, in fact, is a wedge bear flag. So the number of attempts the market makes to resume is also the same as the number of legs up in the pullback. Leg up, a pullback, resumption down. Leg up, resumption down. Leg up, resumption down. Each leg in a bear trend has 1 or more bars. Each leg in a bear flag usually has 1 or more bull bars. So here we have 2 bull bars, and this is a bear flag in this bear trend. Here's bear trend resumption, and here we have many bull bars in this pullback. It's a weak rally, probably a bear flag, and you can see the trend resumed. In a bull trend, if the high of the next bar goes above the high of the current bar, then the current bar becomes the buy signal bar. So here we have a bull trend and a pullback, and then the bull trend resumes here. This is the buy signal bar. This is what signals traders to place orders to get long. They place a buy stop 1 tick or 1 pip above the high of that bar, and then they get long here. And this becomes a high 1 bull flag, or a high 1 buy signal bar, or a high 1 reversal. So this bar is a buy setup. It's a high 1 bull flag. The first attempt down, immediately reverse up. It could have a second or third leg down and become a high 2 or a high 3 bull flag. That's the buy signal bar. And that's the high 1 entry bar for the bulls. The high 1, when it triggers, it ends the first leg of a sideways to down move. So you have a bull trend, you have a high 1 buy signal bar, and then when a bar goes above that bar, that ends the first leg down. It may be the only leg down, but it ends the first leg down. Here we got a new breakout, so we start the count over again. Here we have a bear bar, so we have a pullback, and it's a high 1 bull flag. Traders will buy either above the bear bar or above the bull bar, stop down here. And then it immediately reversed down again. So this becomes the second attempt to resume the trend. So this is a high 2 bull flag. You can call this a high 1 or new high 1. You can call it a high 2. You can call this a high 3. So 1 push down, 2 pushes down, 3 pushes down, a wedge bull flag. Or you can say we got a new high, so let's start the count over again. This is a high 1 and that's a high 2. Here, this high 1, we tried to get a resumption up from a double bottom. This low, that low, we have a double bottom. You can call it a high 1, first pullback from a new high. You can call it a high 2 because we're in a tight trading range. So we tried to resume up, went sideways, tried to resume up again. You're looking for reasons to buy. You're in a bull trend with no credible top. So the first attempt to resume up makes this a high 1. Again, you could call it a high 2. Doesn't matter. You're looking for reasons to buy. Let's say we got a new high, a pullback, so a high 1 buy. And the next occurrence of a bar going above the high of the prior bar is a high 2. So we tried to resume up, we failed, we went down again. And this becomes a high 2 buy signal bar, and this becomes a high 2 entry bar because it went above the high of that bar. Here we have a bull trend with many examples. This bar went above that bar, a high 1, but the pullback continued, so we have a high 2. We tried to resume up, we pulled back, high 1. We pulled back a little bit here. This high is below that high. Resumption, high 1. Or you could say we just went sideways, so it's a high 2. Anytime there's a double bottom, it's a high 2 buy. This, we reversed down. It went below the low of that bar and then went outside up. So this is, in fact, a high 1 buy signal bar. The market went below the bar and then above. A new high, new pullback, high 1. High 1, new high, same thing here. Tried to reverse down. So the high of that bar is where bulls enter. They buy 1 tick above that bar. Sideways, a double bottom, so a high 2. Now, a high 3, when it's sideways, it's a triangle. A pullback that's sloped downward, it's a wedge. And here, this is mostly sideways. It does not look at all like a triangle. Here we went above that bar, high 1. This one above here, high 2. This one above there, high 3. So you can call it a tight trading range, you can call it a bull flag, you can call it a high 3, you can call it a triangle, doesn't matter. You're looking for reasons to get long, and all of those are reasons. You can buy above the high 1, above the high 2, above the high 3. Any of them is fine. Stop is down here. The whole purpose of bar counting is to look for reasons to enter a trade. You're trying to come up with a logical reason to enter a trade. Every double bottom is a high 2. Very strong bull trends will have a high 1, and then another high 1, and then another one. Sometimes you'll get 4, 5, or 6 high 1s in the same bull trend without a high 2 or a high 3. That is very unusual because trends tend to weaken as time goes on. So maybe you get 1 or 2 high 1s and then you start to get high 2s or high 3s. This is an example where we've had 5 or 6 consecutive high 1s. This is just very unusual. After each strong breakout to a new high, you raise the stop. So when it breaks to a new high, stop is here. A good breakout bar here. Stop is now below that pullback bar. Here are the stops. Every time you get a new high, not so much here, but at this point, the stop is now here. New breakout here, new breakout here. Pretty good bull trend, about 8 or 9 consecutive bull bars, most of them closing near their highs. You need to get long. Many ways to get long. You can buy below bars, you can buy bull closes, you can buy the market. If you want an easy to learn system, you look to buy high 1, high 2 bull flags, high 3 bull flags. Three big bear bars closing on their lows. Maybe you don't want to buy the high one. Chances are, big up, big down, big confusion, we're going to go sideways, and we'll probably get a double bottom. You can buy here, stop down here, or you can wait to buy the high two. And a high two doesn't have to be one leg down, pullback, and a deeper leg down. Sometimes the second leg is above the first leg, and it's just a sideways pullback. It's still an ABC pullback or a high two bull flag. They're betting on bull trend resumption. That's why you're buying above these pullbacks. Here, double bottom. Double bottoms are rarely perfect. This is a double bottom as well. So this is a high two bull flag. But with the three bear bars, I would rather wait for a second entry. So we have a new double bottom, a higher low double bottom with a bull bar. To me, that's a pretty good bet that the market is going to go up. Now, we got a little pullback here, an implied one. This low does not go below that low. So on a smaller time frame chart, this is a pullback. And you could call it a high one, high two, or you could say three pushes down, 1, 2, 3, in a sideways pullback, and it's therefore a triangle. A triangle is just three pushes down and a pullback that is mostly sideways. There are lots of ways to label bull flags and bear flags in a bear trend. It doesn't matter. Don't lose sight of the goal. You're trying to find a reason to enter, and bar counting gives you one way to do that. Now, bulls also count the number of bear bars that are followed by bull bars. Bear bar, doji, so that's one little pullback. Bear bar, doji, another little pullback, and then a new low, another pullback. Here, a pair of bear bars, pullback, and then a bull bar. A series of bear bars, and then a bull bar. So to me, this is one leg down, and then an inferred end of that leg, and then more bear bars, bull bar, inferred end of the second leg, and then a third leg down here. Same with over here. Bear bar, and then a bull bar, so that's one leg down. So I would call this second leg down, and then bull bars, and then another good bear bar, so third leg down. We have a high one bull flag here, a double bottom, so a high two, and now we have three pushes down, one, and then a bull bar, two, and then a bull bar, and then a third push down. These are dojis, but then we get the bull bar here. You can call this a triangle, you can call it a wedge, it's sloped down somewhat, it doesn't matter. You got a decent bull trend, you have about 7 or 8 or 9 bar bull microchannel, so you assume the market's going to resume up, and you're looking for reasons to buy, and counting the pullbacks gives you a reason. Here, we went down and then a bull bar, another bear bar, and a bull bar. This is a high two buy above this bull bar. You could buy above this bear bar as well. It's a strong enough breakout. We're probably going at least a little higher. You can also count the number of buy signal bars. Here's a buy signal bar, it triggered, a buy signal bar, it triggered, and then we broke to the downside. We have a third buy signal bar above this bar, right? This is the buy signal bar, the entry bar. You can also call this a high three bull flag. Again, strong bull trend, stop down here. You can buy the high one, you can buy the high two, or you can buy the high three. You're looking for a reason to get long because you believe the trend is strong enough so that it will probably resume. So pullback, high one, we got a high one here, 6 bar pullback, and then we got an attempt to resume here, so high two and a high three. Functionally, it's the same as a wedge. Here we got 6 bars down and then a rally, and then to a lower high, and then another 10 bars down, and on some higher time frame, this is just a large high two buy setup. So high one, pullback, and then a second leg down. And the second leg down is subdivided into 3 smaller legs. Buying above this bar or above these bars, you can call it a large high two. You can call it a big high two buy setup. So leg one, pullback, and then leg two. I wouldn't buy here because it's a 6 bar bear microchannel, but maybe buy here, certainly buy above this bar. When the market's in a bull trend, you're looking for a reason to buy because you believe the trend is going to resume. Still a bull trend, looking for a reason to buy. So you want to buy as the market reverses back up. So you buy above a high three or above a high two, and same with here, above a high two. Same here, high two, high three, high two. You can buy above any of these, high one, high two, or high three bars. I mentioned that we have a bear bar, bull bar, so first leg down. Bear bar, bull bar, second leg down. Bear bar, dojis, so third leg down. So you can call this a triangle. It's sloped down somewhat. You can call it a wedge bull flag. You can call it a high three. In any case, a high three, a wedge, you're looking to buy, either above the doji or higher probability above a bull bar that closes on its high, so you get long over here. This is a wedge top, 1, 2, 3. You can call it a low 3 top. Usually, if you're in a trading range, and this might in fact be a trading range, it did turn out to be a trading range. If it's in a trading range, I would call it a low 3. At this point, this is all that I see. I think it's a bull trend. So yes, it's 3 pushes up, 1, 2, 3. On a higher time frame chart, it might be simply a low 3 rally in a trading range, but I don't see that. So for me, I would simply call it a wedge, 3 pushes up, 1, 2, 3, and look to sell a reversal down, expecting a couple legs down, 1, pullback, 2. Bears will sell the reversal down. Now, I said anytime you have a double top, it's a low 2. So you can call it a double top, you can call it a lower high major trend reversal, bull trend, bear breakout, lower high. You can call it a low 2 in a trading range. You're thinking that after a wedge channel, we're going to enter a trading range. And this is a double top. Every major trend reversal top is a double top. Sometimes the second high is below the first, sometimes it's exactly the same, sometimes it's a higher high. But all major trend reversals are types of double tops. So you sell the reversal down below the bear bar. 3 pushes down. Even though this rally went above this, the start of the pullback, it's still a wedge. So 1 push down, 2 pushes down, 3 pushes down. Or other computers will say, hey, this is the first push down. We have a lower high here, and second push, third push. Different computers do it different ways. I would say that this is part of the pullback, even though we went to a new high in the bull trend. I think this is part of this pullback. So it's a wedge bull flag where the top of the pullback is above the top of the bull trend. Many computers treat it that way, and they look to buy a resumption up. Sometimes a bull trend or a trading range will have big legs down, and sometimes the legs subdivide. Here, high 1, second leg, high 2, or maybe this is a high 1 and this is a second leg up. Doesn't matter if you call this a high 1, high 2, high 3. In general, with a strong leg down like that and a strong leg up like this, I would view this as a large high 2. So first leg down subdivided, so high 1 and then high 2. Here you have a second entry buy. After 4 bear bars, a lot of bulls will not buy that. They'll wait for a second entry buy. And you can call it a high 4. We attempted to bottom here, a complex bottom, 1 pullback 2, so it's complex. The bull tried to resume, but failed to get a new high. The bear resumed down, the correction resumed down, and then we got another complex buy, high 1, high 2. So you can call it high 1, high 2, and then high 3, high 4. So this is a high 4 bull flag. Or you can call it consecutive bottoms, where you have a high 1, high 2, and then another high 1, high 2. This is a second attempt to reverse this large pullback in this bull trend, and second attempts usually are higher probability. So it's a high 4 bull flag or consecutive bottoms. Now, I said earlier that if you start getting high 5s and high 6s, you're probably in a bear trend. And once you get another bear breakout like this, you're probably either in a bear leg in a trading range or in a bear trend. You can call it a high 5, but I usually don't use the term high 5. I stop counting and stop looking to buy pullbacks in a bull trend, and I start looking to sell rallies in a bear trend. We have a bear trend, a 6-bar or a 5-bar bear microchannel, no pullbacks, and then we have a pullback. And you can see this bar went below the low of that bar, so the bear trend is resuming. That makes this the low 1 sell signal bar, and this the low 1 entry bar. So it's a low 1 bear flag, or a low 1 reversal, a low 1 sell signal. So this is the signal bar, and this is the entry bar. Now we got a bear trend, and we have a low 1 sell. That ends the first leg in the pullback. It may be the end of the entire pullback, but sometimes the pullback will continue, and you get a second leg. And I count the number of times that the bear trend resumes. So resumed here, so a low 1, and then when this goes below that, it's a low 2 sell signal. Still going down, a new bear breakout, so I start the count over again. This becomes a low 1. A sideways pullback, this becomes a low 2 sell signal. You can call it a low 1 again. You could say we had a new low and it's a low 1. in general, when I see a double top, I call it a low 2. But you got to be careful here because we have 3 pushes down, 1, 2, 3, and a pretty good bull reversal and a bad looking sell signal bar. So I personally would not take that sell. So first push up, second push up. So low 1, bear flag, low 2, bear flag. This is still a lower high, so it still can be a pullback from this bear trend. It could be simply a bull leg in a trading range. In either case, you can count. So low 1, and then another attempt to pull back. So low 1, and then another leg up, an attempt to reverse, and then another leg up. So we got 3 pushes up, 1, 2, 3. This is a low 2 that did not trigger, and this would be a low 3 sell. And this would be a low 3 sell signal. A wedge top, 1, 2, 3. Also a large low 2. It's a double top, bear flag. It's below this high, and it's a double top. So that is a reasonable sell signal, either as a double top bear flag, a wedge bear flag, or 3 pushes up, a low 3 in a trading range. In this video, I talked about what a pullback is. It's a pause or a minor reversal in a trend where the probability is the trend will resume. I also talked about bar counting, which is the number of times within a pullback that the market tries to reverse before the trend resumes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on pullbacks and bar counting. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on pullbacks and bar counting. In this video, I'm going to be talking about double top bear flags and double bottom bull flags. I will also talk about consecutive reversals, which I sometimes call high 4 and low 4 reversals. All double tops are low 2 sell setups, but don't sell unless the context makes sense. Here we have a small double top. Here we have a bigger double top. Double top, so this is a large low 2 sell, even though it's subdivided and it's also a wedge bear flag or a wedge lower high. Small double top, so it's a low 2, low 1, low 2. All wedge tops are low 3s. First push up, low 1. Second push up, low 2 did not trigger. Third push up, it's a sell below that bear bar. All wedge bear flags are low 3 bear flags or low 3 sell setups. This one is also a double top bear flag, so it's also a low 2 with this, and it's a low 3 with this. 1, 2, 3 pushes up. All double bottoms are high 2 bull flags. We got a small double bottom here. We have another double bottom here. We have a double bottom here. But you don't enter unless the context makes sense. Double bottom in a pretty strong bull trend, reasonable buy. Double bottom around a 50% pullback. We have a bull breakout of a bear trend, higher low major trend reversal. That is probably an okay buy as well, at least for a bounce up. Now, all wedge bottoms and wedge bull flags are high 3s. Sometimes a wedge has 4 pushes, so 1, and then maybe 2, and then 3, or 3, and then 4. And a lot of times the count is not clear. So a bear channel, first push down, second push down, third push down. That's one reasonable way to look at it. And then we got a little double bottom here, 1, 2. This is below that. You can call it a double bottom. It's also still around a 50% pullback in this bull trend. So a spike pullback channel, probably going to get a bounce up to near the top of the channel. So that is a reasonable buy, especially with good buying pressure, good bull bar here, and then good bull bar here closing on its high. Very tight channel, so probably a minor reversal, meaning a bull leg in a trading range, but still can be a profitable buy. Here we have a bull trend, a fairly broad channel here, but fairly strong bull trend here. A double bottom, so it's a high 2 buy, a high 2 bull flag, a double bottom bull flag. So a pretty strong bull breakout. You can buy above that bar, you can buy above any of these bars for trend resumption up. Anytime I see a double bottom, I think of it as a high 2 bull flag. 3 small pushes up, 1, and then this tail is 2, and then we resumed up with that bull bar. So that's a small wedge. but a fairly tight channel, so a minor reversal in a broad bull channel, so that's not a particularly good sell. And here we have a wedge lower high. Maybe it's a lower high major trend reversal. Bull trend, bear breakout, a wedge lower high. If you did take that short, and then you start to see 2, 3, 4, 5 bull bars and a bull breakout above the wedge lower high major trend reversal, you're probably going to get at least one more leg up. So a strong bull breakout above a wedge lower high, a wedge top, you have to assume at least a small second leg up. Is that it? Maybe that's the end of it. But we're still going sideways. Maybe this whole thing is another bull flag and we'll get a bigger leg up. Again, you're looking to buy. You see a strong breakout where you're not expecting a breakout, so you got to be thinking the bull trend is going to have at least one more push up. Double tops, double bottoms, they're rarely perfect. So we have a double bottom bull flag and a weak bull trend. Second low is slightly below that low, but it's still a double bottom bull flag. This is a double bottom bull flag as well. You can buy above that bar. Two big bear bars, I'd wait for a second entry. Here we have a micro double bottom, down and then a bull bar, so up and then down again. So maybe buy above that bear bar or above this bull bar. For any of the buys for anything in here, the stop is below the bottom of the bull leg, so trade small enough. And if you exit your long for any reason, you got to look to buy again. If the market does not clearly become short, this is not enough for me to think it's short. If it does not clearly become short, then I'm always looking to buy. If I exit or if I get stopped out, I'm always looking to buy on a reversal back up. So here's a reversal up. So if I exit here, here's a double top, a micro double top, so a second entry short, I'm looking to buy again. Pretty good bull bar, that's a decent buy. Bear breakout, weak rally, and we have a double top. I'm looking to sell, a reversal down. This is slightly a lower high. You can sell below that little doji or below that bear bar. In general, I prefer to sell below bear bars. It's a higher probability sell. But I'm sometimes selling a little bit lower, so my risk is a little bit bigger. Anytime I see double top bear flags, here's a double top bear flag in a bear trend, or a double bottom bull flag in a bull trend, I'm always thinking about a measured move. When you look at this, you see all these bull bars, and you think, how can that possibly reverse down? It's a minor reversal, a very tight bear channel, even with 4 bull bars. 5 out of 6 bars are bull bars, 4 of them closing on their highs. It doesn't matter. It's the first reversal up from a tight bear channel. It's a minor reversal. The bulls probably need a major trend reversal to create a rally. For the bears, it's a double top and a slightly lower high, and it's a short. Is it a high probability short? Maybe not. Maybe 50% chance, but it's still a decent short. So sometimes you'll have a bear trend with a pretty strong rally, and you think bull trend, but you look to the left and see a tight bear channel, and you say, nah, minor reversal. We'll probably get at least one more test down, and a possible double top. Maybe we'll break below the neckline of the double top and fall for a measured move down. When you have a strong sell-off leading up to the double top, it doesn't matter that this rally is strong. It's still more likely, at best, a bull leg in a trading range, and it might be simply a bull leg in a double top. We have a double top, the 2 highs are not at the same price. I always first use the lower high to create the measured move, and if it falls below that, then I'll take a look at a measured move down using the higher one. Here we have a broad bear channel. Sometimes in a broad bear channel, the market has a rally that's so strong that it makes the market always in long, as it did here. But you always have to be suspicious if the rally does not go above the top of the prior leg down. This could simply be a buy vacuum test with a little buy climax bar here at the end of that high, and if it turns down from a lower high, you have to be thinking about a possible double top bear flag. You can sell below that bear bar. Probability is we're always in long, so probability is we're going to go sideways. However, there's a 40% chance that we're going to go down. We have a double top neckline. 40% chance we'll fall for a swing down, measured move down. Higher probability, wait for a breakout or a follow-through bar, or a break below the double bottom attempt, especially a big breakout like that, and one of these follow-through bars, you sell the close. So a very strong reversal up, 6 or 7 bull bars, most closing on their highs, but does not get above the prior lower high, so we're still in a broad bear channel. Bears will look to sell this. You can call it a double top bear flag, a low 2 bear flag. You can sell below that bear bar, not yet high probability, but the risk is small because you're selling here, stop is here. If you wait for a much higher probability short, you stop. Maybe it's here, maybe it's here, maybe it's all the way up here. So your stop might be all the way up here. You're risking more, but you have a higher probability of a profit. That's a good trade-off. A sell climax down below the measured move. Double top, neckline, measured move down. Bears tried to take profits, did not get filled, but we did not reverse up strongly. We collapsed down, and bears did take profits here. Now, we got a double bottom here and a double bottom here. Do you see the difference between the two? Here we have a bear trend and a double bottom. Maybe this is a reversal. It's probably a minor reversal because it's only a few bars down. It turned into a major reversal, but I call this a major trend reversal or a minor trend reversal because we're in a bear trend. This, however, on the right, we've broken out to the upside already, and we're pulling back. I would call this a double bottom bull flag. In a bull trend, if I see a double bottom, I call it a double bottom bull flag. In a bear trend, if I see a double bottom, I call it a double bottom reversal attempt. Double top, do you see the difference between these two? If I see a double top in a bull trend, I think of it as a double top reversal. Could be minor, could be major. If we're in a bear trend, clearly a bear trend, and then get a double top, I call it a double top bear flag. So bear flag in a bear trend, reversal if it's in a bull trend. It doesn't matter if it's a flag or a reversal, you trade them the same way. Once a clear bear trend is a double top bear flag, double top bear flag, you're looking to sell. Low 1, low 2, double top. Low 1, low 2, double top bear flag. Every double top in a bear trend is a low 2 sell setup, and therefore an opportunity to get short. Enter on a stop below the prior bar, betting on resumption down. Enter on a stop below the prior bar, betting on resumption down. Very strong bull breakout, probably always in long. Not very good follow through. This is an expanding triangle. 3 pushes up and then low and lower. So this is an expanding triangle buy signal, and we got a very strong bull breakout. And here we have a double bottom now in a bull trend, double bottom bull flag looking to buy. Because of the bad follow through, a lot of bulls might not buy this. I think it's okay to buy that. It's a small wedge bull flag, bear bar, bull bar, bear bar, bull bar, bear bar, bull bar, so 3 pushes down. You might wait instead for the double bottom bull flag, which usually happens if you get too much selling pressure in a very tight bear channel in our first leg down. Sometimes you get a double top in a bull trend, and maybe it's a bear trend, but it's not clear yet. It doesn't matter. You trade it the same way, whether it's a double top reversal or a double top bear flag. Here we have a bull trend, a bear breakout, lower high major trend reversal, and it's also a double top lower high major trend reversal, double top lower high major trend reversal. So it doesn't matter if you want to say we're already in a bear trend and it's a double top bear flag. You can call it a double top reversal. Doesn't matter. You trade them the same. You're looking to sell a reversal down, especially below a bear bar, like right there. Once you are fairly clearly in a bear trend, you can call it a double top bear flag. But again, it doesn't matter. If you call it a flag or a reversal, you're looking to short. I am now going to talk about consecutive reversals, and they are all variations of a high 4 top or a low 4 bottom. It's pretty common for the market to try to bottom, like right here, we're trying to get a wedge bull flag, 1, 2, 3, or 1, 2, 3, yet then the bottom fails. When the breakout is strong and there's pretty good follow through, the odds are there'll be at least a second small leg down. Here we have a wedge bull flag, we have a strong bull breakout, wedge bull flag, very weak reversal, weak signal bar, and we got a collapse, a 2-bar reversal. Big bear bar closing on its low, and then a follow-through bear bar closing on its low. Strong enough so that there probably will be at least a small second leg down. Doesn't matter, you can call this a high 2, leg 1 pullback, leg 2 pullback, you can call it a wedge, doesn't matter. It's an attempt at a bottom, the bull flag. The bulls expected a resumption up. Instead, they get a bear breakout. And then we have a second complex bottom. You can call it a wedge, you can call it high 1, high 2, doesn't matter. It's an attempt at a bull flag. And then we get a second attempt at a bottom. leg 1, leg 2. I don't care if you call it high 1, 2, 3, 4, 5, or if you call it 1, 2, 3, 4, or if you call it first bottom and then second bottom. Whenever the bottoms are complex, in other words, have 2 or 3 legs, and you have a pair of them, the odds of a reversal are higher. So you can call it a high 4 variation with a high 5. The key point is we got a bottom attempt and it's complex. It has 2 or 3 legs. And then a second bottom attempt, again complex, 2 or 3 legs. When you get a reversal up from that second bottom, the chances of 2 legs up are higher. It's a fairly high probability buy setup. Some bulls will buy the first reversal up. That's reasonable. And they'll get out here or on that close maybe. Or they'll hold with a wide stop, maybe below here. And then look to add on. Here I would not, here I would. This is a strong enough reversal so that there's a 60% chance there'll be at least a small second leg sideways to down. Bulls might be disappointed by the buy signal bar, the number of big bear bars compared to the absence of big bull bars, a weak entry bar, a pair of bear bars, so they might get out below that bear bar, betting that we're going to fail, or they'll get out on a stop below that low, or they'll get out on that close or this close. If they do get out, they should be ready to buy again on the next reversal up. This is actually a fairly low probability buy because there's only one decent bull body, and even that bar has a big tail on top. And we have 4 consecutive bear bars closing on their lows and then a weak buy signal bar. So this is probably going to be a minor reversal, which means a leg in a trading range. Low probability buy, much higher probability buy here. High 4, it's often a high 2 plus another high 2. First leg down, second leg down. It's a high 2 attempt. Here's a second entry on the high 2, or you can call it a triangle if you want. 3 pushes down, 1, 2, 3, 4 pushes down. Bear breakout and bear follow through bar, so probably at least 2 legs sideways to down, 1 pullback 2. Whenever there's a reasonably strong breakout, a lot of bulls will start the count over. You'll see this as first leg down, second leg down. So this is a high 1 buy here, and then a high 2 buy there. Other bulls will say it's simply the bull flag growing further, and they'll count it as high 1, high 2, high 3, high 4. Doesn't matter. The key point is the market tried to resume up here, failed to get a bear breakout with follow through, so probably a couple more legs down, and the next reversal up will have a higher probability of being successful. A high 4 is often a high 2 plus another high 2. Here we have a bull breakout, a high 1, and then a high 2 attempt. This is actually a Forex chart, and this bear bar actually went 1/10 of a pip above that bull bar, enough to trigger a high 2 buy. And then we had a bear breakout and a follow through, so a high 3 and then high 4. This could have been a high 3, but it did not trigger. Whenever there's a big breakout, a lot of bulls will start the count over again and call this a high 1 and a high 2. Other traders will just say it's all part of the original pullback. High 1, high 2, high 3, high 4. It's also a large high 2, so it's a nested high 2 pattern. Leg 1, pullback, leg 2. On a higher time frame chart, this would be 2 large legs down, 1, pullback 2, and each subdivided, 1, 2, and then this subdivided twice into 1, 2, 3, 4. Doesn't matter. The key point is high probability buy above here or above here, at least for a scalp, and at least 2 legs sideways to up. First leg, pullback, second leg, sideways. This bar did not go above this bar. The key point, 2 legs, usually up, but sometimes sideways. Now look at this. There's a high 1. There's a high 2. Here's a high 3. If you want, you can say it's a high 1, breakout, and then another high 1, and breakout, another high 1. To me, when you have a tight bear channel like this, and it's trying to reverse repeatedly, it doesn't matter. Those reversals are going to be bear flags. You don't want to be looking to buy when the market looks like this. The pullbacks are lasting only 1 bar, maybe 2 or 3 bars, and they're not going up very far. The channel down is very tight. So in a bear trend, you should not be looking for high 1 or high 2 or high 3 buy setups. Bear trends are always forming wedge bottoms, 1, 2, 3. And the channel is so tight here that the odds are the reversal is only going to be minor and create a bear flag, a selling opportunity. Remember, 80% of reversals in strong trends fail. And when the channel is this tight, the chance of a major reversal is small. So you're only going to get a minor reversal, which means a bear flag. Experienced traders know that, and they're not looking to buy, but they are paying a lot of attention to these buy setups because they expect they will fail and become bear flags. They are looking to sell. Instead of looking for high 1, high 2, high 3, high 4, they're looking to sell low 1, low 2, low 3. Pullback, low 1. Breakout, another pullback, low 1. Another pullback, you can call it a micro double top, you can call it a low 1, you can call it a low 2, you can call it a triangle, 3 pushes up, 1, 2, 3, doesn't matter. You just know it's a pullback or a pause in a bear trend, and all you can do is sell. Another pullback, you can call it a low 1, you can call it a double top bear flag here, you can call it a low 2, doesn't matter. You got to be looking to sell. I talked about consecutive tops, consecutive complex tops, where each of the two tops have 2 or 3 legs. Very often it's a low 2 and then another low 2, so it's a low 4. I think of all of these tops as variations of low 4s, but sometimes they're low 5s or low 6s. For example, here, 1, 2, 3, so low 3, and then we get a breakout, and then we get 2 more legs up. Here it's a 1, 2, 3, 4, 5. It's still a variation of the same process. So when the first attempt at a top is a wedge, you get a low 3, and here we got a low 2 after the low 3, so it's a low 5. It doesn't matter if you call it a low 5, it doesn't matter if you start the count over again and say it's a low 2 and what will probably transition into a trading range. The key point is the bears had a reasonable top, at least for a pullback into a trading range. Instead, there was a bull breakout, and then we have another couple legs up and another reasonable top. Chances are you're going to get at least a couple legs sideways to down. 1, pullback 2, and actually extended further. Strong bull breakout, a couple bars up above the wedge top, probably at least 2 legs up, so 1, pullback 2, maybe 3. And a lot of traders will just start the count over again anytime there's a big breakout. 1, 2, 3, 4, 5. Doesn't matter if you call it a low 5 or consecutive tops. The key point is you have a complex top, 2 or more legs, and then another complex top, 2 or more legs. The probability is high that you're going to get at least a couple legs sideways to down. If you do sell here, you can get out with a stop there, you can get out with a stop above this bar, or you can hold and use a measured move up, maybe a little bit greater than the height of the wedge up here somewhere, and then look to add on. I would not add on the first reversal down, although you could. However, this is a high probability add on there. So you can exit above the wedge and then look to sell the reversal down, expecting at least a couple legs sideways down. A lot of bull bars, pretty tight channel, really not a very high probability short. However, it's a reasonable short, and whenever you take a reasonable trade, if you manage it correctly, 90% of the time, a good trader can avoid a loss and usually make a profit. Here we have a bear breakout and a low 1 and a low 2. One problem is you get 5 bars without a bear body. In fact, you get 8 or 9 bars without a bear body. So this is not a very good looking low 2 sell signal, despite a very strong bear breakout. However, you have to be aware of the possibility of a low 4 and a trading range. So low 1, low 2, bad sell. Then we get a bull breakout and a follow through bar, probably at least 2 legs up, 1 pullback 2. And up here, it's a very tight bear channel, normally a very low probability sell, except that we're testing this high, and this looks like a trading range. Many reversals up and down. Bull breakout, so you might start the count over again. Complex top, low 1, low 2. Breakout, low 1, low 2. High probability that the reversal down here will be minor and lead to a trading range because the channel is so tight, but the context is good for the bears, so some bears will take that short. Other bears will wait for a second entry, like below that bear bar. If you want, you can call it a low 4. Does not matter. The same is true in a bear trend. You got a reversal, maybe a trading range. It is a trading range, but a lot of traders will be looking to sell. You can say this is a low 1, low 2. You can say this is a low 1, low 2. Then we get a breakout, and then pretty much sideways for a second leg up. Strong breakout, so a failed low 2. But now you can look at it as a wedge, 1, 2, 3. Some traders will sell below here. And management is a little bit tricky. They might get out above this, they might get out above here. If you do get out above there, you got to be looking to sell again because of the possibility of a complex top. We tried to top here, we got a breakout, and then a second leg up to a complex top. Or you can look at it as a wedge, 1, 2, 3. and then a bull breakout above a wedge. In general, if you get a bull breakout above a wedge top, 50% chance the breakout will be successful, 50% chance the breakout will fail and reverse down. This is not a strong looking bull breakout, and this is a terrible looking bull breakout bar. Once you see this bar, you know the odds are not 50%. They're more like 60% that the breakout will fail and we'll get a couple legs sideways to down. You can count it low 1, low 2, low 1, low 2, wedge 1, 2, 3. Even though this high is below that high, the market is trying to form a bear flag. And it got a small bear breakout, and the key point is it was followed by a strong bull breakout, so probably a couple legs sideways to up. It's a variation of a low 4. The key point is it's a second attempt to reverse, so a higher probability. Here, a very strong bull trend. We got a wedge top, 1, 2, 3. Maybe another wedge top, 1, 2, 3. Strong bull trends, maybe a parabolic wedge, 1, 2, 3. Strong bull trends are always forming wedges. They're always trying to reverse. But look at the pullbacks. A couple tiny bars, one bar, one bar. You cannot be looking to sell this. Gaps between this high and that low, this high and that low. This is an extremely strong bull trend, so don't start looking for low 1, low 2, low 3s. When you're in a very strong bull trend, a low 1, low 2, low 3 is a sell setup, and you cannot be looking for sell setups. So instead of looking for low 1, low 2, low 3, low 4, you should only be looking to buy. You should expect each one of these reversal attempts to create bull flags. A high one, high one, high one. And you should be looking to buy the bull flags and not sell the tops. At some point, the market evolves into a trading range. And at that point, it's no longer a strong bull trend. And if you're going to trade it, you trade it like a trading range, not like a trend anymore. You're buying low, you're selling high, and scalping. I talked about a low 4, 1, 2, 3, 4. On a higher time frame chart, it's usually a low 2, and if you go to a high enough time frame chart, it's a low 1. So a 5-minute chart, low 1, low 2, low 3, low 4. On a 10-minute chart, it's just low 1, pullback, low 2. Complex corrections like this are usually simple corrections on a higher time frame. After each breakout, you start the count over again. We got a breakout, high 1, a breakout, high 1, breakout, high 1, high 2. Small breakout, you can call it a high 1, or you can call this a double bottom and say this is a complex high 1 and a high 2. Doesn't matter. It's a bull trend you're looking to buy. In this video, I talked about double top bear flags and double bottom bull flags. I then talked about complex reversals, which are variations of high 4 bottoms and low 4 tops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This video is on pullbacks and bar counting. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on pullbacks and bar counting. I'm first going to be talking about endless pullbacks, pullbacks that just continue to grow until they become an opposite trend. I'm going to then move on and talk about pullbacks on higher and smaller time frames. And then I'll talk about the importance of counter trend traders exiting when there's a high 2 or a low 2. Here's an example of a strong bull breakout, and it's starting to pull back. Different ways to count it. 1, 2, 3. You can say this is 1, 2, 3, and then 4. But anyway, it's a fairly tight bear channel, and that is a warning that the first reversal up probably will be minor. And a very tight bear channel like this, lasting 20 bars like this, beginning over here, you have to be thinking that there's at least a 40% chance of a bear breakout in a bear trend. In general, a bear trend inside of a bigger bull trend is a bull flag. It begins as a pullback, and as it grows, it becomes more of a trading range. Here, a trading range that's sloped down. And once it reaches 20 bars or more, I call it an endless pullback, especially when the channel is tight like this. And when that happens, the probability of trend resumption up drops to 50%, and the probability of trend reversal down increases to 50%. So around here, 50% chance the bears will get a bear breakout and a trend down. Again, you can call it high 3, high 1, high 2, high 3, high 4, 1, 2, 3, 4. Doesn't matter. It's a wedge bull flag. 3 pushes down, so it's a wedge bull flag. But the channel is very tight, and the pullbacks are small. Just 1 bar, 1 bar, 1 or 2 bars, 1 bar. And that reduces the probability of strong resumption up, and it increases the probability that any bull breakout will be minor and lead to a continuation of the developing trading range instead of a resumption of the bull trend. In general, whenever you have a bull flag, only a 40% chance of a bear breakout. But once the bull flag, the bear channel, reaches 20 or more bars, and especially if it's in a tight channel like this, probability is more like 50-50. The key is to wait to see if you do get a bear breakout bar and a follow-through bar. And here we have a bear breakout bar, tail on the bottom, not especially big, but here we have a very big bear breakout bar, despite the tail on the bottom. And then there's a follow-through breakout bar, so the odds are we'll get at least a second leg down and at least a measured move down. It's probably a measuring gap, but this upper range is so small, we've already gone more than a measured move down. But the key point is a big bear breakout with follow-through below a bull flag, we're probably going to get at least a couple legs sideways to down. Here's the opposite situation. We have a series of sell climaxes here, 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 a little bit here, and then we're pulling back. But the pullback is in a very tight bull channel. We tried to resume down here, we tried to break to the upside here, tried to reverse down here. The entire thing is a pullback, and it's lasting a long time. And the more bars that get added to a pullback, the lower the probability for trend resumption down is, and the higher the probability for trend reversal up is. Once the pullback has 20 or more bars in a very tight channel like this, 50-50 chance you're going to get a bull breakout of the bear flag. I call it an endless pullback once it hits 20 bars. So you got to be ready for that bull breakout. And here we have a bull breakout and a follow-through bar. Probably we'll get at least a second leg up. Is this the second leg? I don't know. Is this the second leg? This? I don't know. But the odds are we're going to get at least a second leg up. It's possible this is the first leg, and then pause, and then we get a second leg up later. Here, we have a 20-bar tight trading range after a bull breakout. 20-bar tight trading range makes the market back to neutral. So at this point, 50% chance we'll get resumption up, 50% chance we'll get reversal down. 24 bars, you can do different kinds of counts. High 1, high 2, high 3, high 4. Bull breakout didn't go very far. And then high 1, high 2. Doesn't matter. 20 or more bars in a very tight channel like this, a tight trading range like this, the probability for the bulls has dropped. And now it's the same as for the bears. Bear breakout, bear follow through, probably at least one more leg down. Here we got 3 more legs down. I want to now talk about higher and lower time frames when you get pullbacks and when you're trying to do some bar counting. Here, this is a 5-minute chart, and it's a trading range lasting a lot of bars, maybe 100 or more bars. And you can do different kinds of bar counting, leg 1, pullback, leg 2, so high 2. And then we have another high 1, high 2. So it's a complex high 1, pullback, high 2. On a higher time frame chart, it's just leg 1, pullback, leg 2. On the higher time frame chart, it's just a big high 2 bull flag. So for example, 60-minute version of this same chart, this becomes a high 1, here's a high 1, and the second leg down is a high 2. This is a 60-minute chart of that. On the 5-minute chart, it's a very complex pullback. On the 60-minute chart, it's fairly simple. And some traders, when they see pullbacks like this that just seem to go on forever and they look very complex and they're very difficult to understand what's going on, sometimes it's helpful to look at a higher time frame chart, and what is going on becomes a lot clearer. Here, 5-minute chart, 100-bar trading range, 100-bar trading range. Move up to a 15-minute chart, maybe a 60-minute chart. This is a 60-minute chart. And it becomes simpler. Here we got a very tight trading range, a low 1 sell, did not work, and we have a low 2 sell. It did work. You can also think about lower time frames as well. Here we have a 5-minute chart and a low 1 sell. It worked. But on a smaller time frame chart, it's probably a complex pullback. You can see this tail down here. So we went up on this bar, and then on this bar, the doji bar, we went down and up, and we have another doji bar here, so probably down and up there as well. Whenever you see a low 1 short on one time frame, here or here, chances are it's going to be a complex pullback on a lower time frame. So a 1-minute version of this, in this case, looked like this. If you're looking at the 5-minute chart and you see a low 1 pullback, it's probably more complex on a lower time frame. You can see that 5-minute low 1 bear flag is a wedge bear flag on a smaller time frame chart. Some traders would pop up the smaller time frame chart and look to sell a bear flag in a bear trend. However, most traders should just trade the chart in front of them. If they're 5-minute traders, just take the short on the 5-minute chart. Again, We have a series of low one shorts on a 5-minute chart, and they can be more complex on a 1-minute chart. Most traders just simply trade the 5-minute chart. But if you wanted to, you could always put up a 1-minute chart. Low one, low two. Micro double top, low two. Five-minute chart. Is this a high one, and then is this a high two? Or is this whole thing basically a bigger high one? High one, buy. I think you can buy above that bar. It did not trigger on this bar. It did trigger on this bar. You can still place your buy stop to buy above the high of that bar, even after this big bear bar. And in this case, you would get long either as this big bull reversal bar went above that bar, or instead you could wait and then place a buy stop above this big outside up bar. You can call it a wedge bull flag, 1, 2, 3. You can call it a double bottom bull flag, micro double bottom, 1, 2. You can call it a 50% pullback of the strong bull trend. And if you want, you can call it 2 legs down, 1 pullback, 2. The point is not arguing, is this a high one buy? Is this a high one buy because it went above that bar? Or is it 2 legs down, 1 pullback, 2? Doesn't matter what you call it. It's a pullback, and we're still always in long, and traders are looking to buy a resumption up. Some computers will see it as a high 1, others as a high 2. And I never worry about the name. I just worry about what's going on. And I want to buy. It's a bull trend. I want to buy. You'll sometimes hear me say that if we have a bull trend and I'm trying to scalp a short, like sell a low one or something, or sell a bad high one, if there's a strong bull trend, you have to assume that reversal attempts will fail. Let's say a trader looks at this and says, big tail, buy climax. Maybe there's a trading range here and it's at the top of a trading range. They'll say, bad bull flag, I'm going to sell with a limit order at the high of this bar. And if they're still short here, now we have a high 2, high 1, high 2 with a bull body. You got to get out. Whenever you have a reasonably strong bull trend, and if you're shorting, you might let the market go once against you, but the second time against you, you cannot do it. You got to get out on the high 2 buy setup. And that's one of the reasons why high 2 buy setups and bull trends are so good, because the bears who are shorting will let the market go against them one time, but they will not let the market go against them a second time. So the bears will buy back their shorts when the high 2 triggers. And that's why bulls will buy that high 2, because they know the bears will give up. Some bears might sell this, but if they do, they're not going to let the market resume up a second time. They're going to get out. And the bulls know that, and the bulls love high 2s for that reason. The high 2 is the second attempt to resume the bull trend, and it therefore has a higher probability of success. And if traders are short, they will exit their shorts if the high 2 triggers, especially if the buy signal bar for the high 2 has a bull body. And if traders are flat, it's a great opportunity to get long. You have a high 2 buy setup with a bull body. So bulls will buy because it's a high 2 and a bull trend. Now, why is it such a reliable buy? Because both bulls and bears are buying. Bears are buying back their shorts and giving up, and bulls are buying because they believe the bull trend is resuming. So there's nobody willing to sell at this price, and the market has to go higher to find sellers. Makes it a great buy setup in a bull trend. The opposite is true in a bear trend. Some bulls will look at this as consecutive sell climaxes, and maybe they'll buy above here, taking a chance that they'll get a scalp up. So first leg up, and then the bears tried to resume down. It never triggered a low one. We did not go below the low of the prior bar. However, we tried to go up again a second time. You can call this a low one. You can call it a low 2. To me, it's a micro double top. We have a strong bull reversal and then a bear bar. And then the bulls tried to reverse up a second time. We have a second bull bar. And if I am buying up here, I now have a micro double top, 50% pullback in a bear trend. The key point is the bulls tried to go up once. They tried to go up a second time. And if the market goes down, I want to get out. You can call it a low 1. You can call it a low 2. It's an implied low 2. We went up and then a bear bar, and then we went up again. I usually call this a low 2, and I'm going to get out of any longs below that bar, even though it has a bull body. It's a micro double top, 50% pullback, and a pretty strong trend. You can also call it a wedge. 3 pushes up. 1, we went up and down, and then up and down. So it's also a wedge. wedge bear flag. Bulls will get out and bears will short. High probability that you're going to get at least some resumption down because there's nobody left willing to buy. The bulls tried twice and they failed twice. That makes a low 2 a high probability sell. We have a bull trend and a wedge top. 1, 2, 3. It triggered either below that bull bar or below this bear bar. However, it's also arguably a high 2 buy with a good bull bar. At this point, a lot of the bears who sold this as a wedge will get out. Other bears will say, bull trend, pullback, looks like we're developing a trading range. So some bears might use a wide stop and scale in high. Most bears will say, I don't know, it's a fairly tight channel. We have a fairly tight channel with a tight channel wedge. Really not a very good sell. Too much risk of trend resumption up. I have to get out above a bull bar. You can call it a micro double bottom and a high 2, but I think you have to get out when the channel is that tight because too much risk that the trend will continue up. Bulls know that. They know the bears took a bad short, selling a wedge top, but a very tight bull channel. Probably minor reversal, and the best the bears get is a trading range. So the bulls will buy that, betting on trend resumption up. Here we have a bull trend, and we have a micro double top here. We have bear bars, several bear bars. Some bears will take this sell, especially if this is within a trading range. We don't see the bars to the left, but if this is a bull leg in a trading range, bears might be willing to sell below this bear bar. However, they have to be careful because for the bulls, it's a high 1, pullback, high 2, maybe a wedge, 1 down, up, 1 down, up, 1 down. So it could be a wedge bull flag. You might get a gap here between this low and that high. The bears who sell here are going to be very quick to get out if this starts to resume up. They'll buy back above this high 2 buy, even though it has a bear body. We have a gap, and it's a high 2 buy or a wedge bull flag. Will they buy above this bar? I don't know. They may be willing to hold above this bar, but if we go sideways and get a bull bar and then a high 2 or a high 3 bull flag, they will get out. And that's what happened here. We had a bull reversal bar. Again, high 1 here, and then a second leg down, high 2 here. Second attempt by the bulls to resume up. If a bear did sell below this bar, they get filled over here. They would either buy above this bear bar. They certainly would have to buy above this bull bar, even though it closed the gap above that high. To me, it's 2 legs down and a bull bar and a bull trend, about a 50% pullback of the prior leg up. Most bears will give up. In this video, I talked about endless pullbacks in tight channels lasting 20 or more bars. They have a 50% chance of leading to a trend reversal. I also talked about pullbacks on higher and lower time frames. If you have a pullback on a 5-minute chart that seems to last forever, 50 bars, 100 bars, and it's hard to read the count, sometimes it's easier simply to look at a higher time frame chart, like a 60-minute chart, and things can be much more clear. Also, if you look at a low 1 short on a 5-minute chart, you can infer a low 2 or a wedge bear flag on a small time frame chart, like a 1-minute chart. And then finally, I talked about the importance of counter trend traders exiting if a high 2 triggers in a bull trend or a low 2 triggers in a bear trend. And that's why a high 2 is such a good buy setup in a bull trend, and a low 2 is such a good sell setup in a bear trend. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the end of the 3rd video on pullbacks and bar counting. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on buying and selling pressure. I'll begin by talking about what I mean when I talk about buying and selling pressure, and then next I'll talk about the importance of gaps. When trading, traders always have to be paying attention to signs of strength, and one way to think about it is buying and selling pressure. Bars often show that either the bulls or the bears are stronger, and when the price action favors the bulls, it's buying pressure. So for example, we got a strong bull breakout, a series of bull bars, very little overlap. As soon as this bar closed, they bought it. You can see the low of this big bar does not fall much below the close of this bull bar. Again here, consecutive bull bars closing near their highs, not much overlap between the 2 bars. Compare that to this. Here we have a big bear reversal bar. Here we have a series of bear bars, several of them closing on their lows, and the bars are fairly large. That is a sign that the bears are reasonably strong, and it usually means lower prices will follow. Bulls buy to make the market go up, and when they buy aggressively, you get bars that look like this, and that's a sign of good buying pressure, and it usually means that the market will go higher. And bears sell to make the market go down, and when you get a series of bear bars closing on their lows, that's usually a sign that the bears are strong. There's a lot of pressure driving the market down, and lower prices are likely. The bulls and bears cannot hide it. These bars are telling you that the institutions are buying much more aggressively than they are selling, and higher prices are likely. And I refer to these as footprints. When you get signs that the bulls are strong, buying pressure, or signs when the bears are strong, it's selling pressure. It means that the institutions are trying to move the market, and there's fairly uniform opinion in the institutions, and that usually means that the trend will continue. Whenever the market is pretty clear, this is clearly bullish, big bull bars closing on their highs, not much overlap between the bars. That's a sign that the bulls are in control, and that clarity is due to the buying pressure. These bars that look like this, and again like that. So what am I looking for? I want to see more bull bars than bear bars when I'm looking for buying pressure. I want to see consecutive bull bars. I want to see bull bodies that are bigger than the bear bodies. I want bars closing near their high and at least above the midpoint. I would like to see bull microchannels, a bull bar, and then another bull bar, and another bull bar, and no pullbacks. I want tails below the bars and not above the bars. I want bull breakout bars with gaps. In other words, the close of the bar above the high of the prior bar, or above the high of many prior bars. And I want follow-through. After a good bull bar, I want another good bull bar. And I want to see the number of consecutive bull bars increasing. If I look to the left on the chart 20 or 30 bars ago, there were 2 or 3 bull bars. I want to see 4 or 5 consecutive bull bars now. I also like to see the bull bars getting bigger instead of smaller. I want the bodies to get bigger. And I also want the number of consecutive bear bars to get smaller. If there were 3 consecutive bear bars 20 bars ago, I only want to see 1 or 2 bear bars at a time. And I want the bear bodies to get small. All right, let's take a look at this chart. First thing that is striking is that there are more bull bars than bear bars, and that there are also consecutive bull bars. There are 4 bull bars here and 5 consecutive bull bars here. And look at the size of the bull bodies and compare them to the bear bodies. The bull bodies are bigger than the bear bodies. I want to see bull bars closing on their highs, or only having small tails on top, like this, like this. Here's one with a big tail, but it's only one of the past 6 or 7 bars. Bull bar closing near its high, certainly at least above its midpoint. I also like to see bull microchannels, a series of bull bars where the low of every bar is at or above the low of the prior bar. Bulls are not waiting to buy pullbacks, they're simply buying at the close, or if the market pulls back just a tiny bit, they start to buy. I want to see tails on the bottoms of bars, which is a sign that the bears tried to break out, and the bulls bought the breakout and reversed it up. And I like to see gaps, either between the close of a bar and the high of the prior bar, or the low of a bar and the high of a prior bar. Again, the low of this bar is above the high of that bar. There's a gap. That is a sign of strong buying. I want to see the bull bars getting bigger. So we have a few bull bars here and then a bigger one. A bull bar here and then a bigger one. Bull bar here and then a bigger one. I want to see surges in the buying. And I don't want to see consecutive bear bars. A bear bar, okay, but it's followed by a bull bar. Good for the bulls. Same here and here. Also want the bear bars to get smaller instead of bigger. So we got a bear bar here, a smaller bear bar here. Let me talk a little bit about a bear trend, and the opposite of what I just talked about is true for the bears. I want signs that the bears are clearly in control, and that clarity comes from selling pressure. I want to see more bear bars than bull bars. I want to see consecutive bear bars. I want the bear bodies to be bigger than the bull bodies. I want the bear bars closing near their lows or at least below the midpoint. I want bear microchannels, no pullbacks. I want the high of every bar to be at or below the high of the prior bar. I want tails on the tops of bars, which is a sign that every time the bulls try to reverse the market up, the bears sell it off into the close of the bar. I want bear bars with gaps, and I want follow-through. So I want the close of a bar below the low of the prior bar. I want the high of a bar to be below the low of several prior bars. I want the number of consecutive bear bars to increase. I want more and more bear bars. I like to see the bear bodies getting bigger. I want to see the number of consecutive bull bars decreasing, and I want the bull bodies to be getting smaller. Let's look at this. We have 3 bear bars, 4 bear bars here, 5 bear bars here. A lot of consecutive bear bars. And the bear bodies are bigger than the bull bodies. Look at the bull bodies here and here. They're small compared to all the bear bars. A sign that the bears are strong. And when there is a tail below a bear bar, I want the tail to be small. I want very little buying into the close of the bar. I want the bears to own the bar right into the close. Also, no pullbacks. So here we have about 8 or 9 bars where every high is at or below the high of the prior bar. So it's a bear microchannel. That's a sign of relentless selling. I also want to see tails above bars. This doji bar at one point was a strong bull bar, but into the close the bears took control and sold it off. So every reversal attempt by the bulls, the bears win by the end of the bar. I want to see gaps. I want to see the close of a bar below the low of a prior bar, and I want to see the high of a bar below the low of a prior bar. So we have a gap. Here, the close of this bar below that bar. The high of this bar below the low of that bar. There's a gap. And I want to see follow-through selling. So after a bear bar, I want to see another bear bar. Small bear bar, bigger bear bar. Small bear bars, bigger bear bar. I want the bear bodies to get bigger, not smaller. I want to see momentum picking up on the downside. And I want to see bull bars either be small or getting small. So if I see multiple bull bars, I prefer them to be smaller, the bodies to be smaller. A sign of the bulls losing interest. In a trading range, the bears are very strong and then the bulls are strong. Bulls are strong and then the bears are strong. Both the bulls and the bears are fighting over the direction of the breakout. I always pay attention to signs of buying and selling pressure because it often helps me anticipate the direction of the breakout, and it can allow me to enter early, before the breakout. Let's take a look at this chart. So we have a bull bar. A bull bar is owned by the bulls, and bear trend bars are owned by the bears. In a trend, one side is clearly in control. The bulls are in control here, bears are in control there. And when the bulls are in control, I expect higher prices. And when the bears are in control, I expect lower prices. I'm going to talk a little bit about gaps. A gap is simply a space between any support and resistance. And here's an obvious gap. A big space between here and there. This becomes support, and this was resistance, and now the market has broken above it. Gap between this low and these highs as well. This area was resistance, the market broke above it, and now it's support. Gap between that low and that high. Different ways to view the gaps, different computers see them differently. I sometimes talk about negative gaps, and a negative gap simply means that there's some overlap. Here we broke out above this breakout point, and then we pulled back, but the pullback is below the breakout point. I call that a negative gap, when there's not much overlap between the pullback and the breakout point, and then the trend resumes. That's important. It's still a sign of a strong bull trend, but it's not as strong as when there is a gap, an actual gap. When there's a little bit of overlap, it works the same as a gap, but it's not as reliable. It does not have the same probability of higher prices. Gaps often lead to measured moves. So we have a gap this high and this low. It's a negative gap, so there's some overlap. Here we got a double bottom neckline, break above the neckline, measured move up. And when you reach a measured move target, you get some profit taking by the bulls, and again here. And you also have bears knowing the bulls will take profits, so the bears sell for a scalp. A lot of gaps, not so obvious. I use gaps differently from how anyone else I've ever seen uses the term gaps, but I use the definitions that I use because they help find trades. They make sense. Here we have a gap between the low of this bar and the high of that bar. That is a sign of strength. We got a gap between this close and that high. A gap between this close and that high. Again, signs of strength. We have a pullback, but this low stayed slightly above that high. So there's an actual gap here. And it's important. On a smaller time frame chart, this doji, this tail, would be a high, and this would be a low, and there'd be a gap between the two. So it tested the high. This was a breakout point, and here's a breakout. And this pullback tested the breakout, and the bulls bought and resumed up. And then look up here. We had a bull bar, but it sold off on the close, and the close was below that high. That's a sign that the bulls are getting weaker. We've got a sell-off here, big gap down, and I always think of a gap as any space on the chart. It's usually a space between support and resistance. This was a support area, the market broke below it, and now that area is resistance. There are other gaps on this chart as well. For example, right at this moment, there's a gap between this high and that low. That gap quickly closed. And ultimately, even this gap closed. Negative gaps, we got a bear breakout and a pullback, but the pullback is above the breakout point. So I call that negative gap. And again, it functions just like any other gap, except that it has a lower probability of leading to a measured move down. It's usually a sign that the bears are not as strong as they could have been. Gaps often lead to measured moves, even when there's a negative gap. The way I look at this is as follows. The market sold off and rallied, and it sold off again, but did not rally much. I think of it as an attempt at a double bottom. So we rallied, we sold off, trying to get a double bottom, but no double bottom at all. But I'm still thinking that, okay, it's a possible failed double bottom, and therefore I want to look to see what the market does around a measured move down. And I think that's how the market views it. When you got a low here, and then a sell-off, a lot of times it bounces and you get a double bottom. And if the market then breaks below the double bottom, you look for a measured move down. Other times, it doesn't even stop at the prior low, so there really is no double bottom. It breaks below that low. I still think of it as an attempt by the bulls to create a double bottom, but the bulls were so weak that there was no bounce at all. Because it was an attempt to create a double bottom, if we break below it, I'm looking for a measured move down. Anytime I see a bull breakout and a reversal below that bull breakout, I think of it as a failed double bottom, and I look for a measured move down based upon the height of the bull breakout. If we did bounce here, we would say, okay, we've got a double bottom, we're bouncing, and if it fails, we'll get the measured move down. Here, we did not get the bounce, but I'm still looking for the measured move down. Lots of gaps on this chart. Easy to overlook. The close of this bar, the low of that bar. There's a gap between the close of this bar and the low of that bar. There's a gap between the high of this bar and the low of that bar. A gap between the high of this bar and the low of that bar. We have a gap here. This closed that low, but it immediately closed on the next bar. So the bears are getting weaker. They're unable to keep their gaps open, and that's a sign that the market might soon evolve into a trading range. In this video, I talked about buying and selling pressure, and I also talked about gaps. And I use gap in a much different way from anybody else. And I do so because I think the way I use it helps traders find and manage trades. I'm Al Brooks. This is the first of 2 videos on buying and selling pressure. Thank you for watching the Brooks Trading Course.